Introduction. Welcome to our YouTube channel where we explore all things related to investments. In today's video, we will be discussing how to invest in bonds in the USA. Bonds are a type of investment that can provide you with a steady income stream and can be an important part of any diversified investment portfolio. We will discuss the basics of bonds, the types of bonds available in the USA, how to buy bonds, and some key considerations when investing in bonds. Part 1. What are bonds? Bonds are a type of investment where the investor lends money to a corporation or government entity for a fixed period of time. In return, the investor receives regular interest payments, known as coupons, until the bond matures. At maturity, the investor receives their initial investment back. Bonds can be seen as a relatively safe investment because they are less volatile than stocks, which can be subject to wild swings in price. However, there are still risks associated with bonds, such as interest rate risk and credit risk, which we will discuss in more detail later. Part 2. Types of bonds. There are several types of bonds available in the USA, including government bonds. These bonds are issued by the federal government and are considered the safest type of bond because they are backed by the full faith and credit of the U.S. government. They include treasury bills, notes, and bonds, and are available in different maturities. Municipal bonds. These bonds are issued by state and local governments to fund public projects such as roads, schools, and hospitals. They are generally exempt from federal taxes and may be exempt from state and local taxes as well. Corporate bonds. These bonds are issued by corporations to fund operations or expansion. They are generally considered riskier than government bonds because the creditworthiness of the corporation issuing the bond is a factor. High-yield bonds, also known as junk bonds. These bonds are issued by companies with a lower credit rating, which means they are considered higher risk. In exchange for the increased risk, these bonds offer higher yields. Part 3. How to buy bonds. There are several ways to buy bonds, including directly from the issuer. This can be done through a broker or by purchasing directly from the issuer. However, this is generally only available to institutional investors. Through a bond mutual fund. These are professionally managed funds that invest in a variety of bonds. They offer diversification and may be a good option for individual investors who do not have the expertise to choose individual bonds. Through an exchange-traded fund, ETF, these are similar to bond mutual funds, but they are traded on an exchange like a stock. They may offer lower fees and greater liquidity than mutual funds. Through a broker, individual investors can buy bonds through a broker, who will charge a commission on the transaction. Brokers can provide advice on which bonds to buy and can help with the buying process. Part 4. Key considerations when investing in bonds. Interest rate risk. Bond prices are inversely related to interest rates. When interest rates rise, bond prices fall, and vice versa. Therefore, if you buy a bond with a fixed interest rate and interest rates rise, the value of your bond will decrease. This risk can be mitigated by buying bonds with shorter maturities, which are less sensitive to changes in interest rates. Credit risk. This is the risk that the issuer of the bond will default on the bond and be unable to make interest payments or return the initial investment. This risk can be mitigated by buying bonds issued by companies with a strong credit rating.
Liquidity risk. This is the risk that you will not be able to sell your bonds when you need to or that you will have to sell them at a loss. This risk can be mitigated by investing in bonds that are traded on a liquid market, such as treasuries. Diversification. It is important to diversify your bond investments across different types of bonds and issuers. This can help to reduce risk and increase potential returns. Fees. When investing in bonds, it is important to consider the fees associated with buying and selling bonds, as well as the fees associated with any mutual funds or ETFs you may invest in. Tax considerations. Different types of bonds have different tax implications. For example, municipal bonds are generally exempt from federal taxes, while corporate bonds are subject to both federal and state taxes. It is important to consider the tax implications of your bond investments when making investment decisions. Conclusion. In conclusion, bonds can be an important part of any diversified investment portfolio. They offer a steady income stream and can be less volatile than stocks. However, like any investment, bonds come with risks, and it is important to understand these risks before investing. By investing in a variety of bonds, considering interest rate risk, credit risk, liquidity risk, diversification, fees, and tax implications, investors can create a bond portfolio that meets their investment goals and risk tolerance. Thank you for watching our video, and we hope you found this information helpful in your investment journey.